Good day everybody, I hope you're doing fine. And after I've done a video before from CCAC and why I think this will go down after the merger, I was thinking more about strategies for SPACs in 2022, and I decided to prepare some slides and share the video with you, and it'll be interesting what you think about them. But before I start, a short disclaimer: I'm not a financial advisor, and therefore this video is no financial advice. This is for entertainment purposes only, and this is no request to buy or sell a stock or an underlying derivative or option of the stock. I'm not responsible for any potential loss if you perform any of the presented options, and just in general, I own calls of PSTH and puts for QNGY, and therefore might be biased. So keep this in mind when I'm talking about these stocks. So I want to present to you a few strategies which I think are possible right now, and I will evaluate what I think about them, if I think they are profitable or should be done right now or could be done right now profitably. So the first one is arbitrage, and it's the arbitrage before the vote for the business combination. And what are the prerequisites for this to be potentially profitable? So it's really important that you purchase under the net asset value, and then you want to redeem for net asset value. So this is the arbitrage you're going for. So the bigger the spread, the better. And in general, since there is the floor from a net asset value, as long as you can redeem, there is low risk in general, and you can potentially profit within a short period of time, which are the positives. However, negatives, the fees might be pretty high, depending on your broker. So check this out before you want to do this, and the time frame might be really short. So there's only maybe 1 or maximum 2 days when you can really redeem these shares, and the price has to be right for you to perform this action. And it depends from broker to broker how many times you have before the redemption offer has to be accepted. So keep this in mind and maybe ask beforehand if you really want to do this. So this is one point why I don't like this strategy in general. The spread is normally pretty slim, and the time frame is really short, so you can mess it up, or maybe it's not even your fault, and maybe someone from your broker messes it up, and then you have loss, which might be really bad. And another thing, which is for me the main thing why I don't like this strategy at all, is because it's detrimental for the business, because they want to raise cash by going public, and if you redeem, then they won't get this cash, so they have to repay you, and then that's not really what the company wants, and this is not anything I really want to be part of. So this is why I'm not doing it. However, I think it might be possible in general. It depends also till when you have to redeem the shares, and it's in the filings of the SPAC. In this case, it's from the CCAC SPAC, and the transfer agent has to accept the tender offer at least 2 business days prior the vote of the general meeting. Keep this in mind. Check it out from the SEC filings, and then check up with the broker how long you have for the redemption, if you're really interested in doing this. And I want to give you an overview again of CCAC, what the time frame is. So in the blue box, you see this is the date of the merger vote, and beforehand, on the 25th, it was around 10ish, and then afterwards it was dropping slightly, and the 27th was the last day which you could have redeemed, and as shown before, depended where you would have tried or bought the shares, you might have profited. And yeah, but as you see, there's a really short window, so keep this in mind. All right. The next arbitrage possibility is to buy units and then later on split them into shares and bonds. So why is it in general possible? So units or SPACs IPO with units, and these units consist normally of one common share and a fraction of a warrant. And these fractions differ between 1/4 to 1 warrant per unit. And these splits of the units to the shares and warrants normally happen between 45 to 90 days after IPO. So if you buy before the unit split, then the split will automatically be performed. If you buy them afterwards, you also can call your broker to split units into shares and bonds. However, there might be some fees involved, and as I show you later on, these might be really high. So what's the strategy here? So buy the unit as cheap as possible, preferably under the net asset value before the split, or you can also do it after the split if there's an arbitrage opportunity. So if you do this, then there might be the possibility for the units to be cheaper than the share and the warrant. So as mentioned before, short time frame, and you can have a slim margin, profit margin. However, there's low risk because of the floor, which is still intact, and normally the shares won't fall dramatically before, like, or maybe after 2, 3, 4, 5 months. So this is something which does not involve a lot of risk. However, as I mentioned before, the broker fees might be really high. One of the examples I know is Interactive Brokers, and the fees might be up to 400, since they say every transaction has to be, or is charged with $100. So if you convert units or sell the units, it's one transaction, and for so that you can get the shares as one transaction, and then that you get the warrants as another transaction. So you have 3 transactions, in total 3 times 100 is $300, and if there are rights, there's another transaction which would be then the 400, which I'm indicating here. I think there are different brokers which are not that expensive. I think they are around $30. I think E-Trade and some other, but I'm not sure about these. So check it out with your broker, and then you might see if it's possible. And as mentioned before, if you're doing a pre-unit split, then it's not sure that, or it's not guaranteed that it's at least that there's the possibility. So this is something to keep in mind. However, in the past, this has been able to, or you could have done this profitably, but I didn't follow it closely in the last few months. I doubt it's really feasible right now. However, just try it out and maybe monitor it. I want to give you a short overview of one ticker which has been or which has the unit split lately, and this is BFAC, Battery Future Acquisition Corp. And as you can see over here, the unit contains 1/2 of a warrant. And just as an example, as you can see, the unit right now, it's still trading, and it's 10:02, and it contains 1/2 of a warrant. So the combination of the warrant, the value of the warrant of the unit would be 0.2, and the in addition to the value of the share, which is 9.8, it would be 10 sharp. So the unit right now is overpriced of 2 cents. However, it could be also the different way. Here you can just have a look if there's an opportunity right now in the market. So the third potential strategy which we choose is SPACs as a cash equivalent. And the strategy would be to buy SPACs before the letter of intent or the merger announcement, and hope to get a good target. And it's best if you're buying it below net asset value, and with no management, since they have a lot to lose. And therefore, I think the chances is that they won't overpay that much, and also that they are really looking how likely it is that the company will succeed. So the positive with this strategy is no low price risk due to the redemption floor. As I mentioned before, the redemption floor is only lifted a few days before the vote for the business combination, and what you're hoping for is for either a pop after the announcement, or that you really like the company with the price they're getting it, and you hold them. So these are the two options. Negative thing about it might take some time, and maybe up to 2 years or even longer for the company to find a target, and until then it's dead capital, and they might even decide to liquidate the SPAC in general if they don't find a target within the timeline. And another potential negative outcome would be that the company which they want to merge with is bad, and you don't really like it, and also the share price goes down, and you're not sure if you then want to sell with a loss or wait for the redemption. And right now it's, in my opinion, pretty bad timing, because the pops after the merger announcement are pretty low. It's low tide right now. Okay, I messed up with the slides. Sorry about that. So there's not a lot to profit right now. It used to be really, really good. So there were times when after the merger announcement, companies popped, or the price went up 10, 20, or even 30% the day after. So that was really good time, but now it's not a good time right now. However, I think, and as I mentioned before, I'm involved with this company, PSTH. This might be a good one, since it's under net asset value. In this case, it's $20 net asset value. And the company which should have brought public was Universal Music, which I quite liked. I think it fit the criteria that Bergman wanted for this company. However, it was not such a big high grower, and therefore the market somehow didn't like it. And but I think this is one part which I like about the SPAC, since I think they're looking for a profitable company, and in this environment right now, this is an advantage in my opinion. So this was the third strategy, and from now on there is some options involved. So if you're not familiar with options, you can buy the right to either buy or sell 100 shares of a specific company, and this is either a call if you want to buy the right to call to buy the shares, or put if you want to have the right to sell the shares. So what would be the strategy right now? It's the same as before. Buy preferably under net asset value, and it's best for serial or well-known sponsors, since they have some reputation to lose, and they're also, I think, more likely to get the deal done. So these are two factors which are advantageous for this kind of strategy. So positive is there's a lot of time, since there are 24 calls available right now, and the potential is pretty high. So either you like the company maybe, and they also have maybe 1 or 2 quarters of earnings and time, or you have until the option expires, and therefore you can have a look at them as well, comparably cheap I'd say. And however, the risk or the negative part is that it's expensive on the one hand, since the spread is pretty high for these long dated options. So sometimes there's a spread of $1 or to $2, and this is something to keep in mind. And depending on the company, there are high implied volatilities, and therefore it's more expensive in general. Transaction cost, this is included with the spread, and another negative point is that it might take some time for the business combination to close, or at least for it to be announced, and until then the capital is not really working, and maybe the SPAC can also be liquidated. Sorry, I messed it up with the German English as well. Yeah, so this is something when you could also lose everything which you invested with a call. And another possibility would also be that the company for the business combination is bad and you don't like it, or it's overvalued, therefore the price might get low or not increase as much as you'd like. So I'll give you an example, and it's again the PSTH aspect which I mentioned before. This time there is the January 19th call for 2024, so it's about almost 2 years left in time, and you can see there are the strike prices and the last price for the transaction and the break-even price calculated from the last price right now. And if you have a look, it's break-even between 2010 to 2307. And what I was doing, I was buying calls at $20. So for me, the strike price or the break-even price would be 2160, and I have time till in beginning of 2024 to see how it develops. And I'm also thinking about buying the $17 calls, since they have a lower break-even price. Yeah, but I'm not sure. I don't really want to put that much capital right now in these type of bets, because I think there might still be some time left for the company until they announce the merger. That's pure speculation on my part. All right, so then there's another one, and another one strategy would be to sell puts, and these puts have to be specific puts. They have to be at the $10 strike price, and they have to expire before the business combination closes, because otherwise you have the risk that the share price sinks. And in this case, since you sell it, or the expiration date is before the business combination, there's still the floor in place, and therefore the price risk is moderate to low. However, the potential profit is also low, and the transaction costs are comparably high, since the potential profit is low, and therefore like any cost is high in comparison to a higher potential profit. So the worst case would be that the price shrinks already before the expiration, and then you might lose some money. And here I brought you the ZNTE SPAC, Sanity Acquisition Corp, and with the call for February 18th. So in this case, it's 1 week out. And if I would be doing it, I would sell the $10 strike price, a strike option. For this case, it would be 15 cents. So as you can see, the potential profit margin is pretty slim, and if you calculate in the transaction cost, then it might be even lower. However, the risk is comparatively low. The volume, unfortunately, is also pretty low, and the open interest as well, so might not be filled, but you could try it. And I think this is an option which could be done profitable right now, dependent on the company. And if you're interested in just have a look at the different companies and see where they are in the process, and if you're maybe not much, might be too far out, or in 1 or maybe 2 weeks, you could check out the March expiration dates, if there might be some good opportunities right now. Next and last strategy I came up with is to short before the business combination, and there are three different possibilities how to do it. The first one would be to buy a put, so to buy the right to sell the share at a predetermined strike price at a predetermined date, and is from these three possibilities, it's the one with the least or the lowest risk, since you can only lose what you've been buying. There's if you bought a put for $2, you can only lose $2 times 100 for the options, so in total 200. You cannot lose more. However, if you sell calls, then you have potentially an unlimited risk, and therefore it's really dangerous. The same goes if you short sell the shares as well. There's potential indefinite risk. However, advantage, you don't have to pay that much for the premiums, for the option premiums. However, if you're really thinking about it, you should really know what you're doing, because the risk is really high, and sentiment can switch really fast. And then right now sentiment is really bad for growth stock and SPACs especially. However, this might change, and then there might potentially be some short squeezes, especially if there are a lot of redemptions and the float is really limited right now. So keep that in mind. However, this might be a good opportunity right now, since you could gain potential profit within a short period of time. Usually, depending when you do it, you could enter within 1 week and then exit the trade, and might have done some good gains. As I mentioned before, really high risk, and be aware what you're doing. As I mentioned before, it's no financial advice, it's just my personal opinion. So I've done a different video on CCAC and the merger with Corner G Systems, and just since I've been following it, just as you can see what would be possible right now. I think around the 24th there was the floor. Till then the floor was intact, and afterwards it went down and down. And on the 31st, I think there was the vote for the business combination. Afterwards it went up quite quickly, I think around 10-15% in 1 day, or even 2 days in a row. However, afterwards it went down, and was around $7 on the 8th of February for the ticker change. And then on the right hand side you see a new ticker, and right now today really drastic loss of around 40%, and it's now around $3. And as you can see, within more than around 2-3 weeks, there's 70% loss. I'm sorry for everyone who was in, but if you're on the other side of the trade, you could have made some money. So this is something, unfortunately, I have to say, this is a strategy I think might be the best right now. However, this can switch dramatically, and I'm hoping it does, because I like it if companies go up, but you have to adopt as good as you can. And I think this right now is the potential way to make money in the short term. Maybe you could, this is what I'm doing. This is no financial advice. I'm pairing it with the leap strategy, and also in a really small part with the cash equivalent strategy. But yeah, this is what I'm doing right now in the short term, and then I'm hoping that you like the video, and would be interesting to hear if you're doing any of these, or think any of these strategies would be suitable right now or is interesting for you. And all the best to you. Until next time, bye bye.